The month of April saw a transition towards a new market regime. While the first quarter was all about monetary policy tightening in the US, dollar appreciation and the fall in commodity prices, April was a different story. As a result of the weaker than expected macroeconomic developments in the US, the US dollar started to depreciate against major currencies and commodities rebounded. As a result, there were significant trend reversals across asset classes, especially on foreign exchange and commodity markets. In this environment, hedge funds posted moderate gains in April, up 0.3%, after a very good start to the year. CTAs underperformed other strategies. Long-term systems were negatively impacted by these trend reversals in foreign exchange and commodity prices in particular, while on the other end of the spectrum, long-short equity managers, and especially Asian long-short equity managers, were able to provide significant support, upside support, and as a result of the equity market rally in Asia and in China in particular. Meanwhile, event-driven managers were fairly resilient, up 0.3% in April as well, despite some deal breaks in the communications sector, in particular the merger between Comcast and Time Warner Cable broke down. But event-driven managers were fairly resilient and still managed to deliver positive returns in April. Going forward, we believe that the trend reversals we experienced in April will continue in May. As a result, we reiterate our preference for short-term CTAs versus long-term CTAs due to the fact that the short-term systems are more able to adapt to these changing market conditions. We continue to prefer as well Asian long-short equity managers for the coming weeks due to the fact that the rally in the region is continuing on the back of the accommodative monetary policy in China. On the long-short equity space as well, we are here changing our stance. We now prefer long-short equity managers in the US with a value bias versus those managers with a growth bias in their portfolio, due to the fact that the rise in bond yields in the US is causing some trouble for those managers that are betting on companies with strong earnings growth. Finally, we continue to have an overweight stance on event-driven managers. The environment remains very supportive for the strategy. The M&A frenzy in healthcare sectors is supporting the strategy, and in the communication sector as well, we are seeing some positive trends that are supporting the event-driven managers.